Alright, good afternoon everybody. My name is Meg and today I'm going to be discussing the fundamental principles of what makes a good tax and how that applies to payroll tax. So payroll tax was introduced into the Australian taxation system in 1941 and the tax is levied on any wages payable by an employer to their employee and is actually administered by states through their own individual legislation. It used to be federal, but that got passed down to the states to implement and administer. Um, it is a self-assessed tax, so employers must do it themselves. They also have to register to make these payments if their wages exceed the specified amount payable by the specific state. This tax has been in the news a number of times over the years, highlighting issues within its legislation. Employers are exploiting loopholes. There's a lot of ambiguity in the legislation and questioning its overall effectiveness and fairness. Payroll tax does fulfil one of the fundamental principles, which would be equity. However, it doesn't meet any of the other criteria for the other principles, which would be, simplicity, certainty, neutrality, and efficiency. So the first principle we're actually going to talk about is simplicity. This is where a tax should be designed and administered to be understandable to the taxpayer. It should be straightforward in terms of what their legal obligations are, and it should minimise any doubt in their mind. So many Australian businesses have employees in different states, and it's quite complex of how they have to calculate the amount of payroll tax owed in each state, as the wages paid to the employee in that state is where the payroll tax is owed. So first off, there are many different variations in the legislation from state to state. So the ACT has a tax rate of 6.8% and an upper threshold of $2 million, whereas WA has a tax rate of 5.5% and an upper threshold of $1 million. And in terms of paying tax to businesses, that's a vast difference. So not only, does that way a portion of payroll tax have to be paid to each state, it's confusing and the calculations just get more and more difficult the more employees you have in different states. So there has been one attempt to kind of harmonise all of the states' payroll tax, and that was the Payroll Tax Assessment Amendment Act of 2010. However, as we can tell, it still has not synchronised major components. So the next principle we're looking at is certainty, and this is where a taxpayer should know well in advance of their obligations and allows them time to formulate a plan so they can comply with the provisions of that tax correctly. So wages defined under payroll tax is essentially wages, salaries, commissions, remuneration, repayments, allowances, bonuses, anything like that paid to the employee from the employer. So there is a massive question over contractors and whether they classify as employees or not. And if you look at the legislation in WA, it's actually really difficult to tell whether somebody would be classified as a contractor or employee because they determine it on a case-by-case basis. So it's a lot of confusion for businesses on whether they're actually following that legislation correctly or not. Many businesses have tried to avoid paying payroll tax by paying contractors instead of hiring employees. However, in a number of other states, they have actually brought in legislation that enforces that they must pay contractors unless specified otherwise and under a certain exemption. So equity is probably the only fundamental principle that does fulfil payroll tax. It does somewhat distribute it fairly across the population through both horizontal and vertical equity. So because payroll tax has two kinds of thresholds, and between that lower and upper you've got that marginal tax rate, the tax is calculated at, and then once you reach that, businesses reach that upper threshold, they then pay a standard rate of tax. So it does fulfil both that vertical and horizontal equity. Alright, so the second last principle we are covering today is neutrality, and that is whereby a tax is considered to be good, it must not influence or sway a taxpayer's choices by distorting the way they regularly carry out activities and their investment decisions and things like that. So where payroll tax does not fulfill this is it's way more attractive for smaller businesses and taxpayers to place their business operations in states that have a higher threshold and a lower tax rate. So if you look at the ACT, rather than Victoria, you've got a lower thresholds of 2 million and then 900,000 respectively. That's a difference of 1.1 million. That's a big difference in terms of like the wages you're paying monthly or annually. So if I were a business, I would choose to start my business up in the ACT because I'm not going to have to start paying payroll tax until I hit that 2 million mark, whereas if I started it in Victoria, I'm going to have to start paying it at that 900,000. So it, distorts where businesses and taxpayers choose to start up their business. And it's just, it distorts the decision making and it fails that neutrality principle once again. And the final principle we're going to be talking about is efficiency. So a tax is considered to be efficient if, it does not skew resource allocation decisions made by the taxpayer across the economy, and in turn this actually contributes to a strong and productive economy. So specifically we're going to look at economic efficiency because payroll tax actually discourages businesses from expanding their business due to the cost advantages of staying small, of staying under that tax-free threshold, of staying, in the lowest possible marginal rate in between the lower and upper threshold too. It's creating an economic distortion of sorts. So the KPMG ECNO-Tech report actually did a study and found that there is an adverse incentive in Australia for businesses to remain inefficiently small. It's had a detrimental effect on the size of businesses as, it's discouraging businesses from growing. There's also the newest clarifications on medical practitioners being classified as employees and now having to pay payroll tax. And I don't know if you've seen in the news or not, but they're being looked into and audited, and we're probably going to see the price increases of costs for patients to go see doctors now, and potentially the loss of bulk billing as a flow-on effect. And once again, this is economically inefficient. It's not contributing to that productive economy, and it's limiting our potential economic output. So the overall formulation and administration of payroll tax doesn't really fulfill a majority of the fundamental principles which make up a good tax and make, a tax should demonstrate. The system essentially is flawed. State governments should probably look to, harmonise and alter their payroll tax systems. So, it's creating that simplicity, that certainty, better clarity for the taxpayers, and they are able to comply then. So, rather than penalising them harshly, maybe making available resources and assistance to help that and facilitate that. But thank you very much for watching the video today. I appreciate it.